a little three. Oh, Brian, welcome to our podcast here on Spark Rental. I am so excited to have you with us today. Brian Daly is the co-founder of Groundfloor. Brian, welcome.
Hey, thanks for having me in. It's great to be with you.
Well, I was telling Brian before we went live that Groundfloor, it happens to be my favorite real estate crowdfunding platform. I have been an investor with Groundfloor for many years now. So that's one of the reasons why I was so excited to have Brian come on today and talk about what Groundfloor is up to and answer some questions for us, because I've got some not difficult, but some challenge or some questions that have been on my mind about Groundfloor for
You
a
can
little
throw me
while now. So
fastballs. It's good. Let's do it.
all right, great. Well, let's start by talking about how you got involved with Groundfloor, because your background is in more law. I understand that you have a law degree from Harvard and you have more of a disruptive technology background. So how did you end up working for a real estate financing company? Or
Well,
founding, rather.
yeah. Well, the truth is, and this is something that as an entrepreneur weighed on me, fueled me in the beginning, still fuels me today. We are all told, and we accept that the problem is we're not getting our fair share of the pie. We as average everyday investors, for example. What I found in finance and in capital markets and individual investing is that the truth is even worse than that. The truth is we're not even being served the same thing. So what motivated us to start Groundfloor was to create an alternative investment product that looks and feels like a public market security with the same types of disclosures and the same accessibility, right? We established a $10 minimum, did about 2 or 3, 4 years of regulatory development work, spent about $1 million in capital to do that, so that we could meet our own high standards for serving you the same thing as the individual investor that hedge funds and private equity and high net worth investors have enjoyed for a very long time. And as a result, we all now get to earn the high yields with less risk and more cash flow than any other product that I have in my portfolio, and any product that I think any of us in the mainstream have access to. So that's what got us going, and that's what's kept us going for 10 years.
Well, I certainly can relate to that. And, that speaks to the same mission that my partner Denny and I have in our investment club. That's exactly what we try to do. We try to make real estate syndication deals, which are private equity deals, accessible to normal everyday people. So I very much appreciate what you and Groundfloor are aiming for here. So let's talk for a second about how the market has shifted over the last year, because 2022 started out white hot for real estate markets around the country, and it ended 2022 with a very different temperature in most real estate markets around the U.S. So as we've seen many markets, not every city in the U.S., but many markets see falling property values, starting around mid 2022 or maybe late 2022. Have you at Groundfloor seen some of your loan default rates or your foreclosure rates rise at all, over the last year?
Look, as an investor, if you're properly positioned, you can make money in every market. The key is to be properly positioned. So for us, the number one headwind to our growth for the first 9 years of Groundfloor's existence was 10% average annual returns looked kind of boring. I know that sounds ridiculous, but clipping 10% every year when meme stocks are going to the moon and you have dog coins, literal dog coins, increasing hundreds of percentage points in a day, what we had to offer looked a little boring. Those financial vegetables look a lot more appetizing in this day and age. I saw recently that a popular e-REIT that's out there on the internet was trumpeting their sense of accomplishment at having beat the S&P 500 by 16 or 18% or something. By the way, for those keeping score at home, that means that you either lost 2% or broke even on your investment, which that is true. It's a good investment by comparison. Groundfloor kept clipping 10% even in those days. And I think in investing, a lot of times the long-term tortoise does beat the hare. The hare explodes. There's risk of ruin, in investing, much like in when you go to a casino with not enough money at a blackjack table and you play too high of a minimum for your bankroll. If you can't keep playing, you can't win the game.
Right.
You lose your stack, and that's true in investing too. So Groundfloor, it's counterintuitive, but we actually are thriving in this environment because the way we grew up, we serve not the most expensive houses in your town. In the 32 markets where we're lending money, we are typically lending on entry level houses or the trade up. There's a lot of liquidity in those markets. Those markets are actually supply constrained right now. And for the investors who we finance, so we provide debt capital. And by the way, now we're providing equity capital as well, which you as an investor can now, if you're a member of Groundfloor Labs, which you can send me an email and I can help you get hooked up with that if you qualify. Groundfloor Labs has some experimental product that allows you to participate in different parts of the capital stack. Our investors have had trouble buying property at a good price, right? And that's really damaging for them because if they can't buy at a good price, they're now taking more risk on the exit price. And the smart borrowers don't do that, right? Whereas if the smart borrower buys at a good price, he can modulate his, investment budget in what he's building, the product that he's developing, to suit the market conditions as they evolve over the course of 6 or 12 months that he's renovating or building that property. And that's what we've seen. So it's not that, yes, certainly foreclosure rates have increased because more projects have kind of gone sideways. That's actually in our portfolio more due to the hangover from COVID with supply chain problems, permitting problems, landlord-tenant eviction law problems, right? We saw more of COVID era problems than we have sort of capital markets or real estate price disruptions. From a real estate pricing standpoint, our portfolio is looking really good. We started offering higher rates to investors and we bumped up the rates that we offer to borrowers. I think we recently calculated, I did a Twitter thread where I weighed in on this and calculated it out. Even if loss ratios increased 7 times what they have been historically for us, which would be enormous, going from say 30 basis points to 210 basis points, investors would still come out ahead and earn a higher absolute or same absolute return as they have in the past few years. So I guess in general, we're well positioned. We've seen the disruptions. Most of them are actually due to what happened during COVID, less about the price action, because price action is very manageable when you're dealing with independent developers who know how to build products for the local markets they serve and can make adjustments along the way. So the price action hasn't really been a factor for us so much over the last year.
Well, I'm glad to hear that. And, it really has been remarkable that Groundfloor has averaged, that annualized return of around 10% for basically since its inception 10 years ago.
Yeah.
So
we made our first loan in February of 2013. That loan, I think, paid 8%. And then, we started raising rates a little bit and dialing it and figuring out, but it's all kind of yielded over time about an average of 10%.
And I realized that we didn't give the high level overview of exactly what Groundfloor does. So, give us like the 30,000 foot view of, what Groundfloor offers to investors and why investors should care.
So Groundfloor offers investors a way to participate in short-term business purpose real estate investment loans that we originate. We are a capital provider to real estate investors who are building a property, renovating a property. They're value-added projects. And the loans are pretty short. They're typically about a year, maybe 18 months. And that's a great thing for investors because you get to put your capital to work. The loans pay very high yields because the investors realize independent investors, unlike the iBuyers and the big institutional money, they actually make higher ROI on their investments than a lot of the institutional guys do. It's a little known fact. they actually make something like 40, 50, 60% profit margin on the products that they're fixing and flipping or building. And so it's very easy for them to pay, say, 10 or 12 or 14% on a loan. It's a great trade for them, and it's a great trade for the retail investor. Now, what we've done is the regulatory work so that everybody can invest in it, and we've formatted it in a way it's hyper fractionalized down to a $10 minimum, not because you're excited to invest $10 in a project and make a few pennies, right, or make less than $1, or over a loan that only goes 10 months or something. The reason we did it down to a $10 minimum is so that you, like a hedge fund, can go build a portfolio of hundreds of these loans, right? The average investor starts off with a couple $1,000s. Well, with a $10 minimum, they can have, 200 loans in their portfolio, right? When you do that, two things happen that are magical and unavailable anywhere else. One, the returns become very predictive. If you look empirically, portfolios that have 50, 80, 100, 200 loans, the average return becomes very, very predictable. The second thing that happens is you get to peel off tons of cash flow. Every month, once you have a portfolio up and running, there are, every week in my portfolio, about 0.5 to 2% of my portfolio is repaying, which means I'm getting about 8 or 10 or 12% of my portfolio back every month, which is about 10 to 15 times what you're going to get from a REIT, right? So it's a very powerful, non-obvious, non-intuitive concept that we've built. And that's why once people experience it, they just keep investing, right? That 2,000 becomes 10,000 by the end of the first year, right? Once they have 10,000 on the platform, they might do an IRA with us and make it 20,000, right? And it's very, very sticky. There's a lot of repeat behavior. And the reason is there's nothing else like it.
Yeah. So there's a couple things that I really love about the business model. First of all, like you said, $10 minimum investment per loan. So, I mean, I have owned an interest in thousands of different loans on Groundfloor, and a handful of those have lost money, not many, but some of them, and then most of them perform just fine. So averaged across time, it's that consistent 10% return that I've earned on those. And I love that these are short-term investments, which are very rare in real estate, right? I mean, most real estate investments are long-term. So the fact that these are secured by real estate, but they're still, fast turnover investments, every week, in many cases, every day of the week, I get email notifications, your loan for 123 Main Street has repaid.
And then are you auto investing too? So it's sort of turning around and putting your money back to work for you?
Yeah, so I personally auto invest in your B, C, and D grade loans as sort of a balance of risk and return. But yeah, I'm not. When I first started investing with you guys, I played that game of trying to pick and choose winners.
Yeah, people do that. Yep.
Yeah, so I would put like hundreds of dollars in a single loan, and then of course that would be like the one loan out of 300 that lost money. So
luck of the draw.
I stopped doing that.
Right.
Yeah.
By the way, it's interesting to me, people in this space who are providing capital and they brag to investors that they've never lost money. When you look under the hood, all that's telling you is they're not making their investors enough money, because we look at the net return, right? And it's difficult to find a lender who returns on net what we do. And it's because we're willing to take more risk. And the reason we're willing to take more risk is our investors, smart investors like you, are highly fractionalized. And that just gives us a lot of ability to sort of get out there on the risk horizon and generate some higher returns. And, of course, we have a lien on the property. So like the bank, we can foreclose. I mean, we're putting you as an investor in the position of the bank. I mean, for once, we all get to be the bank, right? And Groundfloor is not scraping off any of your profit, right? That you get paid what we get paid. So if we foreclose and we have a lot of expenses and the foreclosure is bad, that's why you might lose money. But equally, if we charge default interest because the loan is late, and this happens a lot, the loan, not all plans proceed on time. That's actually, you learn over time, that's a good news scenario, because instead of 12%, you just made 14%, for some period of the loan. So there's a little bit of nuance for people to get used to, we realize, but once people do, they love it.
Yeah. And, you just brought up another important point about Groundfloor that I that I really like is that we as passive investors in Groundfloor, uh, you don't charge us any fees,
No,
which is unlike every other crowdfunding platform who
correct.
does charge their investors fees. We just collect the same interest that you guys are charging on the loans. You guys make
Exactly.
your money off of fees to borrowers.
Right.
So, which that ties into a question that I've been meaning to ask you ever
Sure.
since I ever since we scheduled this conversation. So Groundfloor has been around for 10 years. It is not profitable yet, to my understanding. So, tell us about your plans for becoming profitable as a company,
Yep.
and why investors should feel comfortable investing money in loans on Groundfloor when Groundfloor itself is not a profitable company yet.
Sure. So there are different reasons for different companies not to be profitable, right? Loss making can be a very rational strategy when the growth is rewarded with increasing returns to scale and operating leverage. And in the early days of our company, that has certainly been the case, right? Because we were able to access, capital, and the way we access capital is actually we sell small slices of ground floor to our customers every year. So, people who invested in our company in 2018 via our first equity crowdfunding round, bought shares in the company at $10 per share. Those shares are now worth $43.90 based on the 2023 offering. So on paper, people have already realized a pretty healthy gain. And the reason for that is we used that capital to build products and to expand our customer base in ways that we couldn't have done without that capital. If we had to be profitable, we would be serving many fewer people. We would be operating at a much lower scale, and it would be very, very difficult to sort of realize the true opportunity that the company has. Now, we are also good stewards of the capital that's entrusted to us, and we realize that it's a time in the market where profitability is important, right? And we're now at a scale where we can be profitable at will. For example, we looked at our budget this year and we realized, you know what? We can pull back on growth, still invest in a lot of new products, by the way. If you go into Groundfloor Labs and you see some of the press releases that are coming out, you'll see we have a lot of new products that we started building a year ago that we've continued building this year that are coming out. We still generate enough profit in the core business, right? I mean, we earn about $10,000 to $12,000 on average per loan at the time we originated, right? I assure you, it doesn't cost us $10,000 or $12,000 to make a loan, and that's why we don't have to charge investors anything, right? That's why you don't pay any fees. Mr. Market determines your return and when you get your money and how much money you get, not Brian Daly deciding how much I'm going to take out of your pocket, right? Like
Right.
every other provider of this investment. So we've built a very profitable business as a capital provider, and we've elected to invest those profits in building products and adding more customers to the platform. Now, when we looked at our budget this year, we said, okay, this year we're going to pull back on those investments. We're going to grow slower. Instead of growing 100% like we did last year, we went from doing 12 million in revenue in 2021 to $24 million in 2022. It was an epic growth year. Now, we also spent a lot of money, in order to build the foundation to support all that growth and the future growth. And we're typically spending money 2-3 years ahead on growth, right? For customers and products and infrastructure. So this year, we're just backing off on that and kind of taking our foot off the accelerator. And by consequence, we're planning to break even. For most of the year, we'll be cash flowing. And that's fine. We have plenty of cash in the bank. We have more cash in the bank. And by the way, unlike other platforms, we are regulated by the SEC. We file audited financials every year and have done that for 9 years. I defy you to find any other investment that has auditors and a qualified opinion and an SEC Edgar filing with all of that detail and a 174-page offering circular with footnotes and the financials and everything that a public company would have, just about. About 90% of what a public company would disclose to you is disclosed to you by Groundfloor. And you can go find those financials anytime you want. And you can know exactly what the health of the platform is and evaluate it for yourself. You don't have to take my word for it. That's also pretty unusual. If you go up there and you do that, you realize, oh, wow, this is a company that's been growing a lot. They've invested a lot of capital in the business opportunity. and they've been pretty successful doing it. We're very disciplined about our finances because we are good stewards, first and foremost. So this year, we will cash flow the company. I think it's going to be a great thing. We're all really excited about it, and I think we're also looking ahead to see, all right, where do we want to continue to invest our profits? Because then the charge will be, well, why aren't you more profitable? Well,
Of course.
because there's a big opportunity, right? We have to balance growth and profitability like every other company with a big opportunity ahead of it.
Yeah, no, that makes perfect sense. And one of those recent products that you guys have launched, a product called Stairs, which I quite like.
Yeah, thanks.
It's a pooled fund that offers full liquidity for anyone who's not familiar with it. You invest your money in, and instead of investing in individual loans, you're investing in a fund of loans. You can pull your money out at any time, penalty free. But the flip side of that is that it's lower returns, right? So 4 to 6% interest on this. Now that has had a cap. The most that you can invest up front is $5,000, and then the most that you can invest in a given month is $500. So I wanted to check in with you about
Yeah.
where this product is headed. Is it always? Are you have any plans to remove these caps on investment in this product? Yeah, tell us more about Stairs.
So Stairs has been a phenomenally successful side project for us. It was an experiment that went really, really well. What people love about it is how simple it is, to put your money to work and benefit from our real estate. Our business is a real estate capital provider, right? So we use that capital that's invested in Stairs to originate loans, hold them for a short time before we sell them on our platform. The
Right.
truth is, we don't really need all of the capital that we're raising on Stairs, which is why we've limited it to $5,000. And we also are not a bank, right? So we're not a deposit taking institution and don't want to be a deposit taking institution. We try to be very clear about that. That Groundfloor is not a bank, shouldn't be thought of as a bank.
Right.
It's
Not
meant,
FDIC insured. Yeah.
yeah, it's not FDIC insured. It's not regulated like a bank. It's not meant to be a bank. And so, I guess what we would say is if you want that kind of liquidity, you should really be looking at a bank, for it, with all the security and everything that comes with that. Now, by the same token, we do want people to be able to, have an experience with us where they have some liquidity and where they are investing and earn a little bit higher yield. But we've just really kept a lid on that. And I think that's sensible, for us as a company. And we've also taken what we've learned from Stairs and we've taken a lot of those features and we're starting to build them into the core Groundfloor experience now. There's a product called Groundfloor Notes that has been soft launched on the platform that if you've been with us long enough or you're a shareholder, you get a chance to use. That's been a very successful product for us, and it's Stairs like in that you can lock up your capital for 30 days, 90 days, or a year, and your investment is backed by a pool of loans, and it's due back to you on a certain date, regardless of when those underlying loans repay. So a lot of people like the certainty of that, and I think those notes continue to be very, very popular in this environment for people as part of their investment strategy. And so
Sure.
we're continuing to learn from Stairs. I'm glad you like the product. A lot of people do, and if you like that product, watch what's coming. It's pretty good stuff.
Yeah. So I'll tell you what we recommend, how we recommend our audience of real estate investors use Stairs is as a holding account for capital that they're planning to invest in some larger real estate project. But real estate investors don't necessarily know when they're going to need
Correct.
their
Yeah.
capital, right? I mean,
Right.
you don't know when a deal is going to come along. It might come along tomorrow, it might come along 6 months from now or a year from now, but you need to have access to that money.
Right.
And you don't want it to lose money to inflation either, especially
Correct.
in this environment.
Yeah.
So we tell people, for money that you plan to invest in real estate projects, but you don't know when you'll need it, put it in Stairs, earn your 4 to 6%.
Yeah.
And, whenever you're ready for it, you can pull it out.
Well, and I'll also say we haven't increased rates on Stairs, purposefully, right? So when we first introduced Stairs, it was 4 to 6%. rates have increased a lot, competing rates on savings accounts and treasuries and all these things. And we've kept the rate right where it is. We like it right there. And it's not as competitive as it was from a rate perspective, but I think the user experience is very competitive. And that's what I think a lot of people like about it.
Yeah. Yeah, no, I totally agree. So, Brian, I want to be respectful of your time here, but do you have any parting thoughts or parting tips for investors out there, whether real estate investors or people just looking to passively invest in crowdfunding platforms like yours? Any parting thoughts?
Yeah, I would just encourage people to take advantage of this moment. This is a moment in time in which regulation, much like it did in the 70s with brokerage accounts, right? Which in 1974, Congress deregulated the brokerage industry in terms of its commissions. And that gave birth to Charles Schwab and all the way through E-Trade and Robinhood itself. And that birthed a great renaissance in retail investing that I think has benefited a lot of people over time. The same thing is happening now in alternatives. And I would just encourage people, I think real estate is the best alternative. I think residential real estate is the most familiar alternative for the rest of us. We know that asset class better than any other alternative, say, than wine or art or collectibles or something. And so I would just encourage people to take advantage of the moment, right? There's a lot of good technology being built out there at Groundfloor and elsewhere to help you do that. There's a lot of good information out there. There are a lot of good, healthy companies now who've grown to a scale where they can actually serve you. And I think it's just a great time to be a retail investor.
Well, I couldn't agree more. And, one of the things that has jumped out to me about Groundfloor and about real estate investing in general is that your money's not going to go to zero, right? Even if an investment goes south, and let's say a loan on Groundfloor has to foreclose, you might lose 10%, maybe even 20% of your capital. You're not going to lose 100% of your capital, like, say, if you invested in a company that goes belly up. So, yeah, I mean, the risk when you invest in real estate, and that includes small $10 investments on Groundfloor and loans, there is, of course, a risk in every investment, but that risk is definitely moderated with real estate compared to paper assets, for example. So,
I personally feel strongly that way. Groundfloor investments are a huge part of my portfolio personally. And it's a nice counterbalance to some of the other things, some of the other risks that I like to take.
Absolutely. Well, Brian, thank you so much for joining us today. It was so much fun talking to you, and we look forward to speaking with you soon.
Thanks for having me.
All right, guys, we will see you next Tuesday, 2 p.m. Eastern. Shoot us emails. Let us know what you want to hear about. Support@sparkrental.com, and stay in touch. All right, bye now.